So I'm delighted to be speaking today with Mansoor Mohi-uddin, who is the Chief Economist at the Bank of Singapore. And as Chief Economist, Mr. Mohi-uddin is responsible for developing strategic views and research analysis on the macroeconomic and financial environment and shaping Bank of Singapore's economic outlook. We recently recorded a discussion with Liz Bottomley, Managing Director in the London branch Bank of Singapore in the UK. And this discussion will build on some of the themes that were brought out in that conversation. So welcome, Mansoor.
Thanks very much, David.
So we're going to cover some of the macroeconomic themes and questions for the Asia region over this brief chat that we have. And just coming firstly to the post-COVID outlook for key Asian economies, which are some of the top performing economies that you see in the region? And which sectors specifically have performed well and will, in your view, continue to generate returns that are robust as we go ahead?
Sure, David. Let me speak first about the economies, and then I'll come to the sectors. In the economies in Asia, we've seen this clear divergence between those economies that have been very good at coping with the pandemic, for example, China, South Korea, Taiwan, Singapore, and Hong Kong, versus those economies, David, which, to be honest, have really struggled with the pandemic. Now, those latter economies are mainly in Southeast Asia, like Indonesia, Philippines, Malaysia, Thailand. But surprisingly, it also includes Japan in this group as well. Now, the big difference between these two groupings is that the first set of countries were able to quickly lock down their economic activity and managed to cope with the pandemic very quickly, but also they had the fiscal resources to support their healthcare systems, but also the economies as well when they were suffering these lockdowns. The poor economies, unfortunately, in Southeast Asia have been unable to do that. Now, why Japan has fallen in this latter group is mainly because of their stop-start policies during the pandemic. They've kept on opening activity and then restricting activity again. So the big lesson for us here in Asia is that all governments really need to get a grip on the pandemic before they feel comfortable enough to be able to open up the economies again. And we expect that will definitely occur as vaccinations improve. So, for example, David, in Malaysia, a country that really has suffered during the pandemic, because vaccination rates are now approaching 80% of the population, economic activity is now beginning to reopen again. So in the long term, all of these economies will rebound. But we can clearly see at the moment, during the pandemic itself, there is a clear split within Asia, David.
Will the weaker economies deteriorate further, do you think, or stabilize? Is there any view as to what will be for the weaker economies?
Sure, that's a great question, David. I do think that we've seen the worst of the pandemic now. The Delta variant clearly surprised governments across Asia because the new strain was just so infectious. Last year, if you remember, Asian economies did pretty well in coping with the pandemic. This year, they have been surprised by the Delta variant. So we think that that's clearly slowed down growth, but we do think that policymakers are getting to grips with it. They're managing to lock down their economies. That's resulted in falling cases, which should allow then economies to be reopened, activity to rebound again now.
Okay, thanks. And coming to the sector
Sure, absolutely, yes. In terms of the sectors, so I'll start off with the sectors that are probably worth avoiding at the moment. It seems quite clear at the moment, let's focus on China because it's the most important economy in the region and the second largest in the world. In China, what we've seen is a whole range of headlines across various sectors where the authorities have decided to tighten up regulations. So this first started in the educational sector, where the authorities decreed that tutoring firms should not be able to offer their services for a profit anymore. Then we saw these regulatory headlines spread further to the technology sectors, say to the tech platforms, but also to for data security. Then we've also seen headlines spread further, for example, to the gaming sectors as well. There's plenty of China's economy and sectors now that are suffering regulatory uncertainty. So we're telling our clients it's too early to jump back into these sectors, despite their stock prices falling significantly over the last few months. So we would avoid those for now. We would stay neutral on those. If clients do have holdings, in those sectors, we're not telling clients that they should be selling their holdings aggressively in an environment where prices have already fallen. We still think the long-term outlook for China is very constructive, but we're not saying now is the time to go back in. In terms of the sectors that we do like, though, particularly for the longer term, there's a couple of things which I think are really interesting in China. Firstly, renewable energy. So as China, as you know, wants to become net neutral in terms of carbon emissions by 2050. So renewable energy is going to be exceedingly important for China over the next few decades. So we're looking at firms which are involved, say, in solar, in wind power, in electric vehicles. They're going to be very important, but also hydrogen as well. So that's the renewable energy sector we think is going to be key here. And the second is essentially what we call new infrastructure. So Chinese authorities are trying to become self-sufficient in key technologies. So we think firms are involved in, for example, 5G, artificial intelligence, again, electric vehicles, robotics, for example, semiconductors. Those firms are still going to be favored by China's authorities as well. So there's the two sectors, David, renewable energy and new technology, which we think we should be favoring for the longer term in China and across Asia.
And on the renewables, could that become a new source of exports as well if they develop the technology to go out and create new IP and export in a way that they haven't done before? Is that part of the plan? Because the domestic market is so huge, if they can cater to that.
Yes, China's authorities are in an interesting position here because, as you know, the last few decades, they have pushed exports aggressively. But now they're more interested in developing the domestic market. So they have this new policy called dual circulation, where the external circulation will still be towards exports, but domestic or local circulation will really be now more paramount for China's policymakers. So it'll be essentially policies that can drive domestic demand going forward. So exports will probably take less of, will take more of a backseat now compared to what they have been for the last few decades, but in terms of China's growth.
Okay, thanks. And just focusing in on China and on the monetary policy, what's the central bank's outlook and likely actions over the coming months?
So since we've seen a very strong V-shaped recovery in China during the pandemic, the central bank, the People's Bank of China, has had a very much a hands-off policy during the recovery. It's kept interest rates unchanged, hasn't had to make many alterations to its stance. But over the last few months, China's economy has begun to slow more quickly than anticipated as they reached the peak of their recovery. So what we saw from the central bank in July was a cut in what we call the required reserve ratio. That essentially allows banks, frees up liquidity for banks to lend more into the real economy again. Now, if we see China's economy slowing further in the second half of the year because they have suffered renewed pandemic outbreaks, then we're likely to see the central bank further cut these required reserve ratios so banks can lend out more of the deposits for fresh loans then. If that still isn't able to support domestic demand, then the PBOC may cut interest rates. Now, so far, the central bank has been very keen to keep interest rates stable with benchmark interest rates. So we think it will take a really serious slowdown, David, for the PBOC to become more aggressive. So it's more fine-tuning that we're seeing at the moment compared to any real aggressive easing from the central bank.
Okay, thanks. And what about projects like Belt and Road? I mean, how do they have an impact on the economy? Is that filtering through into growth numbers?
Sure, Belt and Road is a very important strategic policy for the authorities. Now, it's a very long-term plan to build infrastructure across much of Asia and into Europe and across Africa as well. So it will always be there in the background providing new projects. But in the short term, David, really the focus is very much controlling the pandemic and then trying to build on these initiatives, as I said, for renewable energy, for self-sufficiency in the new infrastructure sectors. So I think they're going to be the drivers of growth again, rather than Belt and Road. Belt and Road is really good at fallback for growth, but it's not going to be a source of new growth at this stage.
Okay, and what's your perception of the inflation outlook in China and the rest of the region? Is there an increase in inflation linked to COVID as we've experienced this shock, or are there more sustained long-term pressures?
So we are seeing definitely some signs of inflationary pressures due to economies reopening, as well, you've seen that particularly in Europe and the US as well. Energy and oil prices are going to become more important. As you know, Asia is a big net oil importer. As oil prices keep rising again, and gas prices are rising as well. That's going to cause inflation to increase in Asia as well. Now, central banks in Asia are still quite cautious, though, in terms of normalizing monetary policy. We have seen one central bank already, the Bank of Korea, increase interest rates. That's partly due to a strong recovery in Korea's economy. But we generally think most central banks in Asia, David, are going to be cautious in raising interest rates. They'll want to see what the Fed is doing, because if the Fed becomes more aggressive in tightening, that'll cause the US dollar to go up against their domestic currencies. But since we expect the Fed will still be pretty dovish in terms of reining back liquidity, it allows Asian central banks to also remain dovish despite inflation being above their targets. These Asian central banks will want to support the recovery first, and then second, they'll deal with inflation later.
Okay, thanks. And what's your view on private clients allocating assets to cryptocurrency? Has it begun to compete with gold as a sense of store of value for investment?
Sure, that's a great question, David, because cryptocurrencies in Asia, as well, I'm sure you have in Europe and the rest of the world as well, are very much in demand, very much of interest to clients. We do think over time there will be a role for cryptocurrencies to play an alternative role to, say, gold as a safe haven store of value. Essentially, cryptocurrencies would be an electronic version of gold, but we're still quite cautious at this stage. There's essentially 4 hurdles that we see that need to be resolved before cryptocurrencies can really become more mainstream. There's 4 hurdles. Firstly, volatility. Volatility in cryptocurrencies is far too high for it to be considered at this stage a really safe store of value. Secondly, trust. We continue to hear of exchanges being hacked, people losing their electronic wallets. So we need to have a trustworthy way for clients to be able to store their cryptocurrencies. And thirdly, regulators are still very cautious, David, about cryptocurrencies. So we see here in Asia, as well as, of course, in Europe and the US, regulators continue to come out with new limits on cryptocurrency trading. And then just lastly, reputational risk. We know cryptocurrencies can be used for illicit activities. So that continues to hinder their progress as a mainstream asset. What we really see, David, and clients here in Asia are very much focused on this, is whether the US SEC eventually decides to approve a cryptocurrency-linked ETF. Now, when that happened for gold in 2003 in the US, then it managed to deal with all those issues that I've just outlined. Gold price became less volatile because a lot more liquidity was introduced. At the same time, you already had a sign-off by a major regulator, so that then took away the reputational risks. Then large financial firms could offer this ETF. So then you also had trustworthy custodians. So that's the major milestone that we're looking for in terms of the development of cryptocurrencies. But so far, the SEC hasn't done that yet. So that's why we're still cautious at this stage, David.
Okay, well, thank you, Mansoor, for talking to me today, and we look forward to sharing this with our members.
Thanks very much for your time today, David.